QuickBooks Online 2021. Multiple currencies, purchase equipment on account, meaning we're going to finance the purchase of equipment within QuickBooks. Let's get into it within It's QuickBooks Online 2021. Here we are in our QuickBooks Online practice file, multiple currencies. In prior presentations, we set up the free 30-day trial, which is recommended given the fact that once turned on, you can't turn off the multiple currencies. You can turn it on by going to the cog up top, going down to the accounting and settings. In the advanced settings, turning on multiple currencies. We're now going to be opening up our balance sheet and income statement by duplicating tabs, going up to the tab to the top, right-clicking on it and duplicate. Duplicating the duplication process, right-clicking on the tab up top and duplicating again. Double duplicate, the good old DD process. We're going to go then down to the reports reports down below, opening up first the P&L, the profit and loss, otherwise known as the income statement. Date, range, change up top from 01/01/20 to 12/31/20. Run it, close the hamburger, hold down control, scroll up just a bit. We're then going to the tab to the left, going down to the reports at the bottom left, opening up the BS balance sheet report. Date, range, change up top from 01/01/20 to 12/31/20. Let's run it and then close up the good old hamburger. Now we're going to be making an adjustment related to the purchase of equipment, and we're going to be paying the equipment in the future in foreign currency. Let's see what we did in Excel, and then we'll do the same thing over here in the QuickBooks file. So we got Excel here. Prior presentation, we did this in Excel because it's a more transparent process to see it in Excel. So we have our purchase. Normally, if we purchased equipment on accounts, you would think, well, we're going to debit equipment, or equipment's going to be going up. But then if we didn't pay for it and we are financing it, then we're going to have to be crediting, instead of cash, we're going to credit some kind of payable, possibly accounts payable or loan payable. Typically for equipment, it might be loan payable due to the fact that we might have like a longer term contract and interest and what that would be on it, as opposed to a short term payable for a purchase of something like inventory or some type of expense account. So this bottom one is obviously going to be the key point here, because now we're going to be paying it in the future, not only paying it in the future, but paying in foreign currency, in this case yen. So we put the machinery on the books with the current spot rate. The current spot rate, which we're saying in this practice problem, is this 0.104, and we're going to be using the currency yen this time. Remember that these spot rates are not accurate spot rates, they're just for our practice problem for demonstration purposes. So we put it on the books then at the US currency equivalent at the spot rate at the point in time that we got the inventory, and then we're putting the other side, which is going to be a payable, on the books as well. So a couple things we'll have to set up first within QuickBooks. We're going to need a equipment account or a machinery type of account to put the machinery into, just normal process. We're also going to be needing to set up yen if we're using yen now, because we were using Canadian dollars last time and we're in US currency for the home currency. And then we're going to have to set up a loan payable, which will be in the foreign currency, or use accounts payable, whichever method we're going to be using. So let's go back on over, do some of that stuff. Go back to the first tab here. We'll set up the account. Let's go down. Well, let's set up the yen first, and we could set up another currency by going to the cog up top, lists item. We want to go to the currencies, and I'm gonna close the hamburger. I'm gonna add a currency, and we're looking for the yen. So there it is, JPY. JPY. We're gonna add that as a currency that we're doing business with. So that means when we have this here, the idea is that we're either going to have some holdings in yen, like a cash account that has yen in it, or we're going to receive money, accounts receivable, or pay money, accounts payable or loan payable in yen. And so this time we're going to set up a loan payable for it. So that is done. Now let's go to our chart of accounts by going to the accounts drop down here with a hamburger and then the accounting on the left hand side. I'm going to hold control and scroll down a little bit. I'm going to add a new account, which is going to be our fixed asset account, because we don't have anything for fixed assets. So let's add an equipment account. Nothing unusual here. We're just going to say this is going to be a fixed asset type of account, and it's going to be equipment. So I'm just going to pick one and just call it equipment. So it lines up to our Excel worksheet. Equipment. This is going to be a long-term asset that we're going to be purchasing, and it does give us the option for the currency down here, which I think is a little bit strange, because normally we would put the equipment, I would think, on the books as basically just the US equivalent currency. So we're going to put it on the books at the current exchange rate. So I believe the standard here, even when using multiple currency, would be to use the US dollar and put the equipment on the books at the US dollar equivalent of the purchase. I think by default, basically all the accounts have this, that are balance sheet accounts have this kind of currency option, except for, strangely enough, the accounts receivable and accounts payable, which are going to be driven by the customers and vendors that will be applied to them. But in any case, I'm going to set this up for the US dollar here. I'm going to save it and close it. So that is now set up. So now we have yen, and we have that item then that's going to be set up. Now, if we were doing a standard bill type process and running through accounts payable rather than a loan, what we would need then is a vendor. So we'd have to set up then the vendor. Let's just go through that practice so we can see how it would look. So we would then go to the expenses here, and I can add then another vendor. I'm going to say new vendor, and I'm just going to call it the JPYV1, which is a strange name, but that's what we're going to call it. And then down here, this is where we would say this one is not going to be in the US dollars, but rather in the yen. So we'd have to set up that vendor for yen. If they were, this same vendor was someone that we're going to pay in the future in both US dollars and yen, some transactions in US dollars, some in yen, we would have to then set up two vendors in a similar way as we did with the customer side of things. So if I was using accounts payable, the vendor again driving the transaction, I'm going to say save it. And then typically, again, if it was going through accounts payable as opposed to a loan, let's see that first by going to the plus button. I'm not actually going to record this, but I'm just going to go to the bill. We would enter a bill then, and then I'm going to say that the vendor is going to be this item, and that will give us the exchange rate here that will then be populated. And then we would enter the category down below, which is the account, which in this case is equipment. So it would be equipment that we just set up. Equipment. And there's a problem here, so I'm going to take a look at my chart of accounts here. I'm going to right-click on the tab to the right and duplicate it again. Duplicate that tab. And let's take a look at our chart of accounts by going to the accounting down below. And I'm looking for the fixed asset category I just set up here. I think I didn't change the name apparently from accumulated amortization, so I'm not sure how that happened, but I'm going to edit this and I'm going to call it equipment again. So I want equipment that we're going to be setting. Okay, so there it is. I'm going to save it, and then if I go down, then I'm going to say, okay, there it is. It looks correct this time. The subcategory not right, but I'm going to say that's okay. Subcategory doesn't do much anything, and then I'm going to go back on over here and say equipment. That's the one we want. We want the fixed asset type of account. And then we would be putting this on the books for, we said, the foreign currency are 400,000 yen. 400,000. I'm going to hold control, scroll down a little bit, and you see the indication up here with the symbol for the yen. And then I'm going to change the rate to 0.104 for our practice problem. So I'm going to change it up here to 0.104 for the practice problem. And I'm just going to choose that for this transaction only. And then it gives us our difference, which is going to be 41.6. And that ties out to my 41.6 date would be 8/30. So I'd say the date would be 08/30/20. And then once again, that messes the rate up. The rate's going to be 0.104. And just for this transaction. So that's what it would look like here. And then it would record this for us, and it would record the equipment going up on the books for the 41.6, even though we're going to pay in the future 400,000 yen, and then the other side going into accounts payable. So this would be the normal kind of process. But again, if we're going to set this up kind of like a loan, then maybe we don't want to use the accounts payable and we'll go to a loan. So we'll come back to this kind of setup with an accounts payable account later. This is probably the easier way to go if it's going to be a straight accounts payable. But if you have to deal with a longer term loan that's charging interest or something like that, then we would do the normal financing type of thing possibly. So I'm going to close this back out, not going to record it. And then let's try to do it a different way. And let's say that typically we would do this with kind of a journal entry. You might be able to use a register in order to do it. So let's use a form. So I'm going to hit the drop down. Now, if it's a loan, there's not a standard document for it. We don't use a normal bill if it's a loan. Therefore, we have to default to kind of journal entry. So I'm going to go to the journal entry type of form over here and see if we can enter this transaction in this format. Now note you have the currency up top, which we can adjust and say, I want to make this once again in yen and do our basically journal entry. We're going to make this as of the date of 08/30/20, and we'll just do this in the format of a journal entry. So equipment would then be going up, equipment, and I'm going to say it's the fixed asset equipment for 400,000. And then the other side is going to be going to the loan payable that we set up, right? We set up a loan payable account. We haven't set it up here yet, so let's call it loan payable, and we'll call it JPY because we're going to pay it in yen. And then I'm going to say that this is going to be an other current liability type of account. And then on the currency, although we have the option down here, I'm actually going to keep it at the US dollar here because the transaction itself is going to be in yen. So I'm going to apply it and label the fact that we're going to be paying it in yen, but recording the US dollar equivalent with the name of the account up here. So I'm going to save it and close it. So save, there's the 400 and the 400. And then if I scroll back down, you could see basically the difference here that has been calculated for us due to the fact that we put it in yen. Now I'm going to change the rate, so it's a lot different here. And again, this rate obviously isn't the most accurate rate, but it's a good practice problem. So it's going to be 0.104. So we'll say now it's going to be 0.104 at the rate. I'm going to change it just for this transaction. Now, if I scroll down, the transaction is going to put it on the books for the U.S. equivalent of the 41,600 and the loan payable at the U.S. equivalent of the 41,600. So the confusing thing about this method, of course, is going to be the fact that when I put the equipment on there, you're tempted to kind of put the equipment on there as if in yen. But if I do it with a journal entry, I can make the journal entry in yen and put it on the books in the US dollar equivalent with the use of the journal entry. And when you put the loan payable on the books, you want to indicate then that you're going to be paying it in yen, even though once recorded, you'll be reporting the US dollar equivalent, the 41,600 there. So let's record it and check it out. So I'm going to save it and close it. Save it and close it, and then let's go to our balance sheet and see if it does what we expect it to do. I'm going to run the report and hold control, scroll up just a bit. And so if I go down, then the fixed asset, there it is on the books at the 41,600. That's what we thought would happen. Ironically, what we planned to happen is what actually happened. And then the other side went to the payable. So there's the payable. And we have it in loan payable here. And again, it's on the books at the 41,600. Now, the little bit of a more of a problem here is, of course, because we did this with a loan instead of with the accounts payable, we can't just, when we do the receive payment for accounts payable, it'll usually record the transaction for us, QuickBooks will. So therefore, we'll have to do a little bit more work in terms of kind of like the journal entry or the recording process of the payment will be a little bit like a two-step process instead of the easy one-step process as it would be most likely if we were running it through accounts payable instead of loans. So we'll see that more. We'll compare and contrast it. We'll go through the payment process with a loan here, and then we'll also set up one with an accounts payable, and you can compare and contrast the process and how easy it might be for the two kind of processes. For now, let's open up a trial balance and just check our numbers. I'm gonna go to the tab to the right. Let's just open it up here. No effect on the income statement, so I'm gonna go to the reports down below. Open up the trusty trial balance, the good old TB trial balance. There it is, and then we'll run that. And so this is where we stand at this point in time. I'll try to print these out so that you get an idea of them and can check the numbers. So I'm going to say 010120 to 123120 on the range change. And so if I compare this kind of to the Excel worksheet, we've got the 100,000 on the checking, and it's upside down, but then we've got the 28,560. That's just because of the ordering of the accounts. And then we got the 41,600 alphabetical order, right? 41,600, the 41,600 here, the 100, the 27,300, and the 1,260 lining up